But what I'm trying to say here, just like gold, it's going to happen in silver. The dollar, the pounds, the euro, they're going to make new lows versus silver. And I think silver is going to really put a rocket up the gold market. I know gold has been doing well, but it's going to do even better once silver really breaks out above 40, 50. It's going to be quite something to watch because silver has been so trampled upon, so manipulated for so many years that it's like a pressure cooker. And that's why I'm holding on to my silver.
Silver is also benefiting from renewed optimism around economic stimulus measures in China. As one of the world's largest consumers of industrial metals, positive sentiment around China's economic trajectory tends to lift silver demand. With increasing expectations for consistent growth signals in Chinese economic data, silver traders have turned cautiously optimistic, positioning themselves ahead of what could be a larger trend driven by industrial demand and macro tailwinds. Financial expert Mario Innecco argues that fiat currencies are losing value while gold and silver hold steady. According to him, silver is significantly undervalued and poised for a major breakout, which could further propel gold's upward momentum. Silver is sitting at the intersection of technical development and fundamental support. Often considered the alternative to gold, silver is now only a few cents away from completing a potential technical breakout above its October 2024 highs of $35.07. While giving his outlook, Innecco highlights China's $27 billion pilot program allowing insurers to allocate 1% of assets to gold. He shares updates on major Chinese insurance firms completing their first gold transactions on the Shanghai Gold Exchange, signaling increased gold investment. TD Securities notes that the Shanghai Gold Exchange has admitted 4 major Chinese life insurance companies as members under a new pilot program, potentially paving the way for a significant surge in institutional gold demand. TD Securities says this development could generate a massive new buying impulse for gold as institutional capital flows increasingly into the precious metal amid a changing regulatory landscape. Highlighting China's strategy, Innecco notes that its pension funds manage $1.3 trillion and add $108 billion annually. He speculates that even a 5% gold allocation would signal a significant shift from US dollar reserves, reinforcing China's hedge against economic instability. With the dollar seemingly losing some of its traditional dominance, investment portfolios could be impacted and must be repositioned to seize the opportunities and sidestep the risks. Now, we present the clips of Mario Innecco's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
And I know the announcement was like over a month ago, and it came out on Bloomberg. China frees possible $27 billion from insurers to buy gold. 10 firms in pilot program that would take effect from last Friday. The companies can put up to 1% of assets in precious metals. The Chinese gold and silver markets very closely. And he posted yesterday and he said, or I even think it might be today, but anyway, China Finance News. Yesterday, Ping An Life Insurance Company of China completed its first gold pricing transaction. That's on the Shanghai Gold Exchange, SGE. PNC completed the first pricing transaction. The 3 major insurance companies have opened the curtain for China's insurance industry to purchase gold. And I think that's really significant. And just another update on the Chinese situation. Chinese pension funds have around 1.3 trillion US dollars equivalent under management. They add around $108 billion, yes, it's not yuans, dollars, equivalent into their funds per year on average. Imagine if they invest 5% of their assets under management into physical gold alongside Chinese insurance companies. Well, I think the floodgates are open for gold, and these 2 stories that I've covered are very much related in my opinion. You've got the old king, the paper dollar losing its luster. even with America's rating agencies. And then you've got China trying to protect its huge dollar reserves by not accumulating as many dollar reserves anymore, by letting off their holdings mature and not add on to it, and buying not just the PBOC and the government buying gold, but encouraging the insurance industry, the Chinese people to get into gold because they know what's coming. And it's the reason why I've been doing it as well for over 20 years, because when I first bought a gold coin, a Krugerrand, it makes you want to look into things. It makes you wonder when you hold that gold coin, how special it is, and it gets you down a rabbit hole. Maybe some of you won't, but I'm quite inquisitive, and I started reading, and I found out that the whole system we're under is doomed and going to zero, because that's what happened to all fiat currencies. So there you go. Interesting times. Hold on to your gold and silver for dear life. That's what I say. It's not gold and silver that are volatile. It's the fiat currencies that are all over the place. But the final destination is going to be gold and silver. And the Chinese know that. Maybe Moody's knows a little bit of that, but I doubt it.
Based on fundamentals, Mario Innecco points out that the Congressional Budget Office has warned of a possible U.S. Treasury payment default as soon as August. Innecco notes that higher Treasury yields will drive up debt servicing costs, creating a vicious cycle of fiscal instability. It is worth noting that there were extended periods when the U.S. yields and gold prices moved concurrently, breaking the inverse relationship. Instead, they pointed to specific times with specific economic and geopolitical drivers affecting the financial landscape. With gold a safe haven asset against inflation and government bonds a safe investment amid stock market volatility, it is unsurprising that investors tend to pursue both in times of uncertainty. If Moody's moves forward with a U.S. credit downgrade, it could trigger market turmoil similar to the summer of 2011. Innecco believes these concerns will push investors away from U.S. Treasuries and toward gold. Rating agency Moody's said on Tuesday that the U.S. fiscal strength is on track for a continued multi-year decline as budget deficits widen and debt becomes less affordable. The agency said in a report that the country's fiscal health deteriorated further since Moody's lowered its outlook on the U.S. AAA rating in November 2023. Let's get back to the interview.
Right now, Moody's is coming out, and here's the story. It came out actually yesterday. Moody's warns on deteriorating outlook for U.S. public finances. And the other thing I've seen before I go over that article is this post here from Richard Whalen, who actually I think worked for the New York Fed. He said yesterday the Congressional Budget Office says U.S. Treasury risks payment default as soon as August. Does this mean no tax cuts, right? So things are like heating up quite quickly here fiscally. The article says here, credit rating group Moody's has warned on the U.S. fiscal outlook, saying President Donald Trump's trade tariffs could hamper the country's ability to cope with a growing debt pile and higher interest rates. And talking about tariffs, everything is changing so quickly. Trump just imposed a 25% tariff on car imports, all cars imported into the U.S., 25% tariff. So just wanted to update you on that. The rating agency said on Tuesday that America's fiscal strength is on course for a continued multi-year decline, having already deteriorated further since it assigned a negative outlook to America's top-notch AAA credit rating in November 2023. While Moody's highlighted the extraordinary economic resilience of the U.S. and the role of the dollar and the Treasury market as backbones of the global financial system, its analysts also warned on Tuesday that the policies of the second Trump administration, including sweeping tariffs and plans for tax cuts, could do more harm than good for government revenues. I just want to make a couple of comments about this last batch or paragraph. Moody says extraordinary economic resilience. Well, I would say that that's been based on heavy deficit spending that took place under the previous administration. And that's probably going to happen in the current administration. A few weeks ago, they passed this continuing resolution or something. I think it was only Republican Congressman Massey who voted against him. He's the only one. Trump wanted to have him removed. And he said that it's just like passing the continuing resolutions or a budget from the Biden administration. He said budget deficit is going to increase by over $300 billion this year, about 290 the year after, and like 200 the year after that. So, the potential negative credit impact of sustained high tariffs, unfunded cuts, and significant tail risks to the economy have diminished prospects that these formidable strengths will continue to offset widening fiscal deficits and declining debt affordability. In fact, fiscal weakening will likely persist even in a very favorable economic financial scenario. Yes, I know the current administration is trying to cut out the waste and corruption, trying to get manufacturing back on board or reshoring. But these things don't happen in 6, 12 months. It takes years. So I'm going to stop right here and tell you why this is important. The fact that Moody's is warning about this, just the fact that they're talking about it, is going to put pressure on Treasury yields, upward pressure on Treasury yields. And that's going to put pressure on the Treasury financing outstanding debt that comes due at higher costs. That's going to increase the interest expense. It's like a vicious circle. And especially if they go ahead and downgrade the U.S., maybe in a few months, maybe it will be like the summer of 2011. So we need to keep an eye on that. And I think this is very good for gold because investors, domestic investors in the U.S. and foreign investors are going to continue to diversify even more away from treasuries into gold. Gold, of course, is money, has been a reserve asset for thousands of years.
Silver is demonstrating strong performance in the current market, potentially outperforming other fiat currencies. A confirmed breakout above the October highs could open the door for further upside, especially if macroeconomic conditions and industrial demand continue to align. With silver gaining momentum, do you see it finally breaking free from suppression and reaching new all-time highs? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.